Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Our first question is from Kathy. Kathy asks, my advisor has me invested in bond funds. Is that a good solution? All right, Kathy. It's great that you're asking about bond funds, especially in the context of retirement income and retirement income planning, right? Bond funds can be a convenient way to access the bond market, but they do come with some considerations, particularly when it comes to generating guarantees, stability, which are crucial in retirement. Unlike individual bonds, bond funds don't offer the same level of predictability. The interest payments from bond funds, which are distributed as dividends, can fluctuate because they depend on performance of the underlying bonds held within the fund. So this means the income you receive may not be consistent or guaranteed to remain at a steady level over time. Moreover, another key difference is that bond funds do not mature. Unlike holding individual bonds to maturity, where you receive the face value back, bond funds are bought and sold at market value, which can vary based on market conditions. So this lack of a maturity date can introduce uncertainty into your investment strategy, especially when you're relying on fixed income for retirement. Now, does this mean bond funds should be avoided altogether? I mean, not necessarily. For investors with less than $250,000 to allocate to bonds and bond-like instruments, bond funds can offer a cost-effective and liquid way to achieve diversification across the bond market. They provide access to a broad range of bonds, which can help mitigate risk compared to holding just a few individual bonds. However, if you have more than $250,000 to invest in bonds, you might consider opting for a diversified portfolio of individual bonds instead of bond funds. This approach can potentially provide more control over your investments, ensure you receive the full face value at maturity, and possibly reduce some of the volatility associated with bond funds. Ultimately, the decision between bond funds and individual bonds depends on your specific financial goals, risk tolerance, and the size of your investment portfolio. It's important to discuss these factors with your advisor to determine the most suitable approach for your retirement income strategy. If you're looking for stability and reduced volatility in retirement, exploring both options thoroughly will help you make an informed decision. Good question, bonds and bond mutual funds. If you would like to send in your question, you can do so. You can email them to poollocke@poolelocke.com. Our second question today from Eddie. Eddie says, my advisor suggested I buy REITs, real estate investment trusts. But after COVID, I'm worried about real estate. All right, Eddie, we're going to dive deeper right now into REITs. Again, real estate investment trust. That's what it stands for, REIT. Let's address your concerns about investing in them in this kind of post-COVID world. As you rightly pointed out, they're essentially stocks of companies that own and operate income-producing real estate properties. Now, evaluating REITs involves looking not only at the potential appreciation of the underlying real estate assets, but at the financial health of the tenants leasing these properties. This tenant aspect is crucial because it directly impacts the income stream and the stability of returns from REIT investments. Now, in many ways, this dual perspective, assessing both real estate potential and tenant creditworthiness, makes REITs akin to a bond-like stock. Now, your specific worry seems to revolve around the office space sector. Given the prolonged impact of remote work trends, it's a valid concern. The landscape for office spaces in major urban centers might indeed face challenges in the near term as companies reassess their office needs post-pandemic, things like that. However, it's important to recognize that REITs encompass a wide spectrum beyond just office properties. There are residential REITs, industrial REITs, medical REITs, and even specialized REITs like those leasing properties to casinos, right? So when considering REITs for your retirement portfolio, diversification across these various sectors can help mitigate specific risks associated with any single type of property. Now, this diversification strategy is key to reducing overall portfolio volatility, especially in uncertain economic environments. Furthermore, if you're investing in REITs, whether directly or through a fund, it's crucial to conduct thorough due diligence or work with a knowledgeable advisor specializing in income strategies. This involves analyzing growth potential of the real estate holdings and assessing the financial stability of the tenants. In practice, evaluating REITs requires both equity analysis to determine the potential for capital appreciation and the debt analysis to gauge the creditworthiness of the tenants leasing the properties. Given the complexities involved, REITs are often considered one of the more challenging asset classes to evaluate comprehensively. Now, in terms of portfolio allocation, it's generally recommended that REITs constitute a modest portion of your equity holdings, typically around 10 to 20%. This allocation can provide exposure to the real estate world while managing the inherent risks associated with the sector. So while your concerns about the office space sector are truly valid, remember that REITs offer a diverse array of investment opportunities beyond just office properties. With careful consideration and appropriate diversification, REITs can indeed play a role in a well-rounded retirement income strategy. Hey, great questions today. If you would like to send in your question, we'd love to see them. You can do so. You can email those questions to poollocke@poollocke.com. And if you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.